Welcome to the Dealmakers Coffee Break. I'm Asaf Raz. Let's go. So welcome to another episode of the Dealmakers Coffee Break edition. This season has been crazy. We've had over 20 episodes already with some amazing guests. And today I have a guest that I've been wanting to talk to him for a long time. And I've been trying to communicate, and eventually we made it. We found a time to do this episode. This is Michael Salafia. He is in the National Retail and Net Lease Investments, and today he's the managing partner of Stax Equity. But this guy has such a long list, such a great vast history in real estate. So I don't want to take away from your moment. So Michael, please take it away. Tell us about yourself, your history, what brought you into real estate, and we can take it from there.
Hey, Asad, thanks so much for having me on. It's a pleasure to be on the show. Yeah, so again, as Asad mentioned, I'm Michael Salafia. I'm the managing partner and founder of Stax Equity. And inside of Stax Equity, we are a commercial real estate investment company. Our core thing that we do, we have a sale leaseback platform for single tenant net lease assets. So that's really our speciality. And inside of Stax, we have an entire ecosystem ranging from Stax Ventures, which is our private equity fund. Stax Equity is our property company that we use for investments and syndication. And we have Stax Real Estate, which is our brokerage arm, which we use for investment sales and some development work. All of these pieces all move together, right, to create what we do at Stax.
That's pretty cool. So what brought you into this whole investment space and specifically real estate? You've done all types of investments. So what specifically draw you into real estate?
You know, I was kind of born into commercial real estate. My family had been commercial real estate owner-operators for over 100 years. For myself, when I was first growing up and I was a baby, my parents and I lived in an apartment above in a mixed-use building, right? So we had our retail stores on the first floor and our apartments above that. And we had many apartment buildings and retail buildings primarily. When I was graduating college and entering into the workforce, it was in the midst of a financial collapse, and iPhones had just come out. So I had pivoted into tech because I was always very tech and design oriented. And I went on a long run there, and that's where I started developing my track record as a serial entrepreneur. I've done several startup companies, everything from Series A, Series B round to exits, tech companies. And I've got to spend a big chunk of my time living in New York City and doing a lot of consulting work for large firms. And that's how I started cutting my teeth in the net lease investment space. It was really working for REITs. And notably, I worked for Moody's Analytics CRE for their analytics platform, and I got to work directly with their chief economist. So I truly got a very holistic approach to the industry, from the economic perspective to the bank's perspective, to the LPs, to the GPs, all the way down to the brokers. And after a while, I had moved to Miami Beach, and I saw that commercial real estate was huge and started doing some networking there. And it was a great place for entering kind of into the commercial real estate investment space. And it was a great time in transition. So I wanted to leverage all of my technology skills and deploy them in the commercial real estate market space to disrupt, to make a difference, to make profits. So that's what I did. I started off by joining Marcus and Millichap and became an investment sales broker. And after going on a great run there and really learning every ins and out, all of the ins and out of the transactional side of the business, that's when I left to launch my own firm, Stax Equity, as well as Stax Real Estate and Stax Ventures.
That's awesome. So you're really born into it. I love those born into it entrepreneurs that are just have it in their skill set since they're kids. I feel like if you have it, you just have it, right? It's in your blood. It's pretty awesome.
Right. And I tried to get away and it just drew me back in, right? But as a result, that's how I got the extra skill set. So it is that technology skill set that really sets Stax apart from competition. We have our own AI program, right? And it's powered by a machine learning algorithm that helps us analyze and underwrite thousands of properties at scale. So we can move faster and process a lot more data than a typical underwriting team or a group of brokers or a analyst committee at an institutional REIT or something like that.
You talked about the single tenant net lease properties, right? Which is what you're focused on today.
Yes.
Can you introduce us to this type of investment vehicle and how it works?
Yes. So for those who are not familiar, the net lease space is a little bit different than typical real estate or typical commercial real estate investments. It actually falls under the category of alternative credit or alt credit, right? The key difference here is with single tenant net lease properties, they are developed into a bond-like structure for the landlord. So in simple terms, you have a property. Say it's a Wendy's fast food restaurant, right? I'll construct the building, and then I'll bring in Wendy's, have them sign a 15-year triple net lease. The landlord will come in and buy the property, and they're buying the property not just based on the cost of the building or the value of the dirt, they're buying it on the net present value of the 15-year lease payments that are guaranteed by that tenant, right? And for these lease payments, the key distinguishing factor is that there are no landlord responsibilities in a triple net lease, in an absolute triple net lease. And there's many variations and exceptions, but in general, the idea is you're the investor and the landlord, you buy the property, and now for the next 15, 20 years, however much lease term you have remaining, you're getting a direct deposit every single month, right? So I'll challenge you all listening to this episode as you're driving around today, take a look at that drugstore on the corner, that fast food restaurant, the gas station, the tire changer, oil shop, even if you drive by a Dollar General or a freestanding grocery store. Most of those properties are considered single tenant net leased assets. Most of those properties are not owned by the corporation, right? Like the CVS or the Walgreens that have their sign on the building. Most of them are actually owned by institutional investment funds, primarily real estate investment trusts or other private equity groups. And then many are owned by individual investors themselves and families.
That's a pretty cool approach. So like you're securing or you're guaranteeing the income for many years to come, right? Which is probably also calculated in your underwriting and the performance of the asset right before you sell it back to the owner. Does that make sense?
Exactly. And it's a very nice asset class to be in, especially for families and family offices looking to grow generational wealth. Typically, aside from institutions like large investors, capital enters into the net lease marketplace from 1031 tax exchanges. So the most common thing that I'll get is, hey, Michael, my family and I have owned this apartment building in New York for 50 years. We just sold it and we've gained $10 million in profits from the sale. So now instead of paying taxes, they can enter into a 1031 exchange and they can defer the capital gains tax burden by purchasing a replacement property. It has to be an income producing property. You have to consult with your CPA or tax professional to get advice on this. But it's a very nice move because basically they can the investor can continue to build wealth without having that tax burden, which then they can pass on to their heirs without tax burden as well.
I think that your specific asset class is one of the most unique ones that we've met so far in all of the episodes. And I think the reason is the fact that you're literally securing the income for such a long time, which provides a lot of, I think, peace of mind for any investor who decides to put his money into this type of deal to say, hey, I already have a tenant. It's a strong tenant. It's not someone that could disappear tomorrow. And he'd have his Wendy's or his oil shop or the CVS, right, for a very long time here. So that's pretty cool. I like it. And I'm sure also your investors like it too when it comes back to returns and tax benefits.
And of course, and it truly is about that. You have to consider when you're removing the landlord responsibilities, right? You're ultimately somebody's paying for that, right? So your rate of return, which in net lease we measure by capitalization rate, and we call it the cap rate. Your cap rate might be a little bit lower than you would see in an asset or a property where you have landlord responsibilities. So that is something to be considered. The other thing that comes in is the credit profile of the tenant. How strong is that tenant's guarantee? When you have a company like CVS Health or Walgreens guaranteeing you to pay you that lease payment for the next 15 years, well, even if they decide to close the store, they still make the payments on it until the lease is up. And this happens. If you have a weaker tenant and they go out of business, it might get taken to court. They might stop paying you rent. And that's why maybe that property is being sold for a higher cap rate than, the CVS or the 7-Eleven that has excellent credit and payment history.
Mm-hmm.
And that's where we come in at Stax. And I saw this opportunity when I was in investment sales at Marcus and Millichap. You have a lot of investors. It's hard to figure out who to trust. And when something goes wrong with your net lease property, let's say the tenant decides to move out early and they're not going to renew their lease. They're going to leave. Or the tenant's business is struggling because their manager is, going through personal issues and it's just not going well. So they want to reduce their rent. That's where Stax comes in. We see the opportunity instead of just asking the investor to give us a listing and then we bring it to market like a traditional brokerage. We actually work with them. We create a business plan. We bring in a new tenant. We do construction and completely re-image and renovate the property. And then once we've stabilized it with a tenant that has a corporate guarantee and a long-term triple net lease, at that point, we'll repackage it as a net lease investment property and we'll bring it to market and sell it to another investor or a REIT.
That sounds amazing. So let's talk a bit about your strategy specifically. When you look at those properties, what makes your strategy unique or different than anyone else when it comes to decision making, right? Like, where do I buy? Why do I buy? How do I choose my tenants? What's unique in what you do?
So we've taken over 100 years of collective experience from all of my market studies and research and mentoring at Marcus and Millichap. We've combined that with all of the best investment principles that are followed by the institutional REITs and their various investment committees. And we've bundled this into one proprietary quant model and then converted that into a machine learning algorithm. So we're aggregating data from multiple sources, right? And we're looking at things with it at a much greater level of detail and in a much more organized way. That enables us to make better investment decisions. This is something, in theory, you could do in pen and paper, but it's going to take you forever. With the way we do it, it's very fast. And now we have many, many data points, even things like mobile foot traffic. We're combining that with store sales reports. We're combining that with these deep data sets of competitor research and benchmarks within the marketplace. And then we're going to normal investor and brokerage things like comps and tax records and interest rates. And when we factor all of that together, that's really what makes the difference. So to get granular, to give you some specific examples, a key factor that we'll look at is the forecasted 5-year population growth. And then once we find a positive indicator, we'll then get very qualitative and we'll look at what's happening in that area. Are you familiar with the Space Coast of Florida? It's like SpaceX, NASA, all that stuff. Mm-hmm. Right. So that's a great example. A lot of investors have overlooked that area. Florida is a very hot marketplace. For me, I'm looking at the massive job growth numbers that are happening in that market. And then I'm looking at the residential development and where the new plans for subdivisions are going in, where the road zoning's going in. And I'm identifying these places on the map. And then once we have it identified, it depends on the strategy that we're working on. But say it's our gas station convenience store redevelopment strategy. Well, then from there, let's look at gas stations that were built, after 1998, right? and look at these properties that we could potentially rehabilitate. And then as we're going through those, we have another set of trade secret questions that we use to qualify or disqualify the property, because there's certain things that happened before 1998 that could be bad for the property. It would make it too expensive for us to redevelop. We'll never get there on the deal. But if everything's right, then it's a great opportunity for us to renovate that store and bring in a new tenant and capture all of the new potential revenue that's going to transpire, because there's more people moving there and the economy's growing. Economic growth is a key factor that we look at.
Okay, so and let's look into. We have two more questions, right? We don't do very long episodes, but I do want to take to pick your brain about the current state of the market and how your strategy kind of shifted throughout this year, or from last year to this year. When we look at interest rates, at debt, property locations, like, has anything changed with what's happening right now?
Yeah, I mean, for net lease especially, it's been hit very hard because of rising interest rates. So if you look at the difference between net lease cap rates, right, that's the capitalization rate. Effectively, if it's a triple net property, that's your return on investment that you're looking for. Now, if you were looking at, let's just think about 7-Eleven, for example. Everybody knows them. That one's easy. They have great credit. The 7-Eleven properties last year were trading at like a 4.5% cap rate. Now we're in an environment where interest rates are 5.5 to 7.5, 8.5%, depending on who the borrower is and what the property is. So it's very challenging. You can't. Why would anybody buy a property at a 4.5% capitalization rate if you can just buy basically for net lease, anytime the 10-year treasury bond, like whatever that is at, very rarely are you going to get a net lease cap rate go below the 10-year T-bill, right? So we're very, very sensitive to that. This created an opportunity this year, right? Because there's a lot of money on the sidelines, and those groups that were doing the national, very strong credit, or call it investment grade credit deals. Those deals are very hard to do right now, and they're almost impossible to finance. You're getting negative leverage. So there was an opportunity to look at new deals that were maybe passed over before, but they could generate higher yield. So that's why this year I've done a lot with smaller, like regional gas station and convenience store operators, right? Who still have a strong guarantee, but maybe they're at 500 locations or 150 locations, that kind of size. It's not the same thing as being a publicly traded company that has a triple B plus or above credit rating. It's a different side of the market. However, with the redevelopment of those deals, we came up with a new program that was very lucrative, and we've done over 100 transactions this year, able to generate about 18% return to our fund by doing it that way. So that's been very interesting, taking a different approach. But it was all about creating that higher yield asset to meet the market demand. We had to create properties and stable net lease investments where you could actually sell them for a cap rate that's above interest rates. And that's been very challenging. And it took a lot of research and a ton of analysis to find the properties that actually had the business fundamentals to support this thesis. But they're out there. It's just, it's hard to find. So as we go through this year, we're hoping that interest rates will calm down a little bit more. And that way we can go back into doing more ground up development for national companies.
I could have this conversation with you for an hour. It's super interesting, but it's not a question, but it's a it's an opportunity. I call it the shameless plug. And this is where you can talk about anything from current investment opportunities, share what you're working on today, very shamelessly, talk about yourself, about Stax, about the opportunity in the company, what you're looking for. This is your time.
Okay, awesome. So key things, if you're watching, if you're a limited partner or you're looking to make a investment into a private equity fund that specializes in commercial real estate, we do still have our round open for Stax Ventures Fund 1. So it's a great opportunity. You can learn more by reaching out to us. The best way to reach me is at STAXRAZ staxre.com, and hopefully there'll be a link in the bio, but to Stax RE, that's for Stax Real Estate, or Stax Equity, all part of the same family. You all get to the same folks. The next opportunity is if you are a tenant, if you're an operator of commercial real estate, say you're a fast food franchisee, if you're a gas station convenience store operator, we do have a lot of great opportunities available where we offer very attractive funding programs to help you open up new stores and open up more store locations. We've helped our operators and our clients open up over 100 stores so far this year, and we've created hundreds of jobs. And we really bring everything together. And, if you're a net lease investor looking for a property, I have a Hallmark listing for a trophy asset. It's a Shell gas station convenience store and car wash. It's located in Coconut Creek, Florida, right off of a busy highway. Fantastic real estate. So yeah, I'd encourage you to look at our listings and investment opportunity offerings.
And Michael, thank you so much for that. And all the information, all the links, everything's going to be in the bio. So they'll know, everybody will know exactly where to reach out to you. We'll see you all, or you'll listen to us in the next episode of the Deal Makers Coffee Break. Michael, thank you so much. I appreciate it. Thank you for joining us. Check out more episodes on the Deal Makers podcast, available on Spotify, Apple Music, Google Podcasts, and Agora's website at agorareal.com/podcast. See you in the next episode.